Imagine waking up tomorrow and finding out that one single decision in Washington could change your mortgage, your credit card bill, your job prospects, and even the price of your groceries. That's the kind of power the Federal Reserve has. And today we're asking, what if the Fed suddenly cut interest rates? Would it spark growth? Would it fuel inflation? Or would it shake global markets in unexpected ways? Welcome back to Brain Fuel Reads, where we dive into ideas that matter, whether it's science, politics, economy, or the hottest debates sparking conversations worldwide. This is the very first episode in our new series, What If?, where we take a potential scenario that could happen in our world, break down how it works, what it means, and what you can do to prepare. And trust me, buckle up, because this one touches every single one of us. All right, let's start simple. What is interest rate? Think of interest rates are basically the price tag on money. When you borrow, the rate tells you how much extra you have to pay back. And if you save, it's the bonus you get for not spending. And the big boss in charge of all of these is the Federal Reserve, the Fed, which sets the tone by adjusting the federal funds rate. Think of it as the domino that knocks over every other interest rate, from mortgages to credit cards to auto loans. When the Fed cuts rates, borrowing gets cheaper and spending and investing are encouraged. In theory, that means more economic growth. And that's just the starting point. But how exactly does one tiny rate ripple through the entire economy? Economists call this the monetary policy transmission mechanism, but let's skip the jargon. Here's what really happens. First, there's the interest rate channel. When borrowing gets cheaper, households are more likely to take out mortgages or car loans, and businesses find it easier to finance new projects. Then, you've got the asset price channel. Lower rates make stocks look more attractive because future profits suddenly seem more valuable, so markets often rally. And finally, there's the exchange rate channel. When US rates fall, the dollar usually weakens, which makes American exports cheaper abroad, but also makes imports more expensive at home. Put all three together, and one small move by the Fed can send shockwaves through spending, investing, and global trade all at once. Now, let's bring this down to earth. What happens to you and me when the Fed cuts rates? For households, mortgages, auto loans, and credit card payments all get cheaper. That means lower monthly bills and more disposable income. For instance, if you're paying a 6% mortgage and rates drop, so refinancing gets you closer to 5%, and that can save you hundreds of dollars a month. For businesses, suddenly it's easier to borrow for new projects, hire more workers, and expand operations. In short, your monthly bills could shrink while your job opportunities grow. It sounds great, right? Cheaper loans, booming businesses, more jobs. But before you get too excited, remember, every turbo boost comes with side effects. Here's the catch. If demand grows faster than supply, prices will rise. That's what we call demand pull inflation. The Phillips curve, another classic idea in economics, shows a short-run trade-off between unemployment and inflation. Lower rates can cut unemployment, but at the cost of higher inflation. And if inflation takes off, the very same Fed that cut rates might later have to hike them aggressively to cool things down. We have seen this before, a version of this after the pandemic, where the Fed slashed rates to zero in 2020. Markets roared back almost instantly. But within a year, inflation was running hotter than it had in decades, forcing massive rate hikes. And this isn't just an American story. When US interest rates drop, the dollar usually weakens because investors aren't getting as much return on American assets. That weaker dollar makes American products cheaper overseas, which is a win for US manufacturers. But here's the flip side. Imports get more expensive. And that matters for you, because so many of the things we buy every day, whether it's an iPhone, a Tesla, or parts for your laptop, rely on components made abroad. Suddenly, those items cost more, and that pushes prices higher at home. So while exporters cheer, consumers can feel the pinch. Of course, we can't forget Wall Street, the one place usually throw a party when rates fall. Stocks tend to climb because lower rates make future profits look more valuable. And bonds go up too as borrowing costs drop. That's why, after the Fed slashed rates in both 2008 and 2020, the stock market came roaring back with massive rallies. But, and it's a big but, just because Wall Street is celebrating doesn't mean the rest of the economy is. Back in 2008, unemployment stayed painfully high, even while stocks were hitting new highs. It's kind of like Wall Street was partying in the penthouse, popping champagne, while everyone down on Main Street was still struggling to pay rent. Sometimes those two worlds couldn't be further apart. Now, we can't talk about modern markets without bringing up the wild card, cryptocurrency. When the Fed cuts rates, traditional options like savings accounts or government bonds suddenly look boring because they're paying next to nothing. And that's when a lot of investors start hunting for riskier places to park their money. And crypto often becomes the shiny object in the room. Take 2020 as an example. Right after the Fed slashed rates to zero, Bitcoin took off like a rocket, jumping from under $10,000 to over $60,000 in just a year. That wasn't random. It was cheap money flooding into one of the riskiest playgrounds out there. Low rates are like strapping crypto to a roller coaster with a turbo boost. It climbs higher and faster when money is cheap. But the ride doesn't last forever. When rates go up again, like they did in 2022, that same fuel gets cut off. And we saw it. Bitcoin and other coins crashed when investors ran back to safer ground. And here's the twist. Crypto has its own identity crisis. Some people see it as digital gold, a safe haven against inflation. Others say it's more like a high-stakes casino, thrilling, but with odds that can turn on you overnight. So if the Fed cuts rates again, expect the crypto roller coaster to roar back to life. Just be ready. The higher it climbs, the scarier that drop can be when the Fed eventually slams the brakes. Before considering what are your alternatives, let's take a quick trip back to two moments when the Fed hit the big red button and slashed rates to zero. First stop, 2008, the financial crisis. Banks were collapsing, the housing market was in free fall, and the Fed rushed in with near zero rates to keep the system from breaking completely. It did help stabilize things, but here's the catch. Unemployment stayed painfully high for years. And because people weren't spending much, inflation stayed flat. In other words, the patients survived, but the recovery was slow and frustrating. Now fast forward to 2020, the COVID pandemic. This time, the Fed again dropped rates to zero, and the reaction was completely different. Financial markets lit up almost overnight. The stock market went from crashing to rebounding in record time. But here's where the story twists. By 2021, demand was roaring back faster than supply chains could handle, and prices exploded. That gave us the highest inflation the US had seen in decades. So same medicine, zero rates. But two totally different outcomes. One was a sluggish recovery, the other was an inflation firestorm. So what should you actually do if the Fed cuts rates again? Well, if you own a home, this could be your golden window to to refinance and lock in a cheaper mortgage. If you're buried under credit card debt, lower rates make it the perfect time to consolidate or finally start chipping away at that balance. And if you're an investor, sure, markets will probably get a boost, but don't let the rally fool you. Those gains can come with some nasty inflation risks hiding underneath. For everyone else, the rule of thumb is simple: enjoy the ride, but don't lose control of the wheel. Cheap money feels amazing in the moment, like free drinks at an open bar, but sooner or later, the tab comes due. And it's often a lot bigger than you expect. So what really happens if the Fed cuts interest rates? On the bright side, it can jumpstart growth, trim down your bills, fire up the stock market, and give US exports a big advantage. But here's the flip side. It can also pour gasoline on inflation, weaken the dollar, and set us up for painful rate hikes later on. Think of it like handing the economy a double shot of espresso. It jolts everything awake in an instant. Spending, investing, markets. But the crash, the jitters, and the side effects are always waiting around the corner. This has been Brain Fuel Reads, and you've just watched episode 1 of our new series, What If? If you love exploring how big global moves ripple through your daily life, make sure to like, subscribe, and hit that bell so you never miss what's next. Until next time, remember, keep your brain fueled.